Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. The New York Stock Exchanges had a rough week. The U.S. dollar skyrocketed, and 10-year yields haven't been this high for 11 years. Dr. Marc Faber, publisher of the Gloom Boom Doom Report, checks in from Thailand. He comments on the Asian economy, the collapse of the darling tech stocks, and the possibility of recession. Seasoned trader Victor Adair gives us his view on the impact the central banks are having on the markets. Is he still bullish on the U.S. dollar? And does he believe the rally in commodities will continue? We'll talk to Ross Clark right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to This Week in Money, Ross.
And it's always good to be with you, Jim.
Ross, the stock markets in the U.S. really melted down. Canada also getting a bit of the side effect. What's the story there?
Okay, so, we had a nice little bounce into the first part of the month, right around June the 1st. But, this was really just a bounce in a downtrend. And all we did was we got back to you take a look at all of those indices, the Dow, the S&P, the Russell, the TSX, the recovery rallies got right back to the lows that we'd seen in the first calendar quarter. They spent the better part here of a week and a half with absolutely no ability to get through that resistance level. At the best, it should have been up, or at the least, it should have been up to the midpoint of the trading range. But in this case, all it did was get up there, kissed resistance, sat around, and then on Friday, there's always going to be a catalyst for these up or down moves. As it is this week, it was the CPI number, 8.6% of reported inflation, which we all know is an understatement. I know that. I actually did a shop the other day, and I was just actually amazed at what the bill was. For my wife and I, I thought when the kids moved out, the bill would go down, but we're paying more than we used to. There were four of us.
What's going on with the U.S. dollar?
With the CPI number, then there's that thought that interest rates will end up moving higher in the U.S. as the Fed does its job of trying to put a bit of a lid here on inflation. And so with a higher rate, which we saw in the bond market, we'll get to that in a second, then that also had an impact as far as the U.S. dollar was concerned. So the dollar index was up 2% on the week. That puts it up to some of the best levels we've seen in a number of years here. And if we take a look at the interest rate side, which was also affected, the 10-year yield now is up around just over 3%, and so that's testing the highs of 2011. So you've got to go back, as I say, 2011. That's the better part here. 11 years ago, we have on the monthly chart. It's 9 consecutive months now of upside action, and that puts it into a bit of an overbought situation. But, overall, the trend, Bob and I have been talking about this bullishness on the U.S. dollar for a long, long time. And clearly, this is just a nice longer trend in motion. You still can buy the dips. And right now, I think, any any pullback would still be a buy as far as the dollar index is concerned.
Mm-hmm. How's the Canadian dollar holding up with the U.S. dollar charging higher?
Well, I had been really good into the middle of the week, and then it got hit here. We've got the Canadian stuck in a trading range between 77 and 80. It had been right back up to the top end of that range, as I say, at the beginning of the week. But with the strength in the dollar and the weakness that we ended up seeing in commodities at the tail end of the week, the Canadian ended up with a poor week there, and I think that still look more just at a trading range. There's so many markets out there right now that are moving, independent of one another, where you would have expected, a strong dollar would have produced weakness in all the commodities and vice versa. But right now, everything's doing its own thing. And, if we look at commodities in general, CRB index was rolling over this week. But you look over at the gold and silver markets, they had a great week. Gold was up 1% on the week. Silver had a decent week. But on the industrial commodities, copper, pretty bad week. You've got the oil market getting a little tired up here. Got up pretty good rally into the early part of the week, but giving back a bit. Once again, that crude oil, as far as we're concerned, trend is really strong as far as I can see. It's still not excessive, so give it the opportunity to do everything it can on the upside.
Ross, thank you so much for the update.
Been a pleasure, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at chartsbyross. Coming up, Marc Faber speaks to us from Thailand. Next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Marc Faber, editor and publisher of the Gloom, Boom, and Doom Report, online at gloomboomdoom.com. He's speaking to us from Chiang Mai, Thailand. Marc, welcome back to This Week in Money.
Well, thank you very much for having me on your program.
Marc, what's the latest at the Gloom, Boom, and Doom Report, and how can people sign up for it?
Well, they can just go to the website, gloomboomdoom.com, and there are two choices, either the more detailed report, mostly for institutional investors and family offices and asset allocators, or the report that is more geared to individual stock ideas that is more suited for retail investors.
How are things in Thailand?
Everything is fine because we have a military government that is not as despotic and authoritarian as the one you have in Canada, who was democratically elected. So I think when it comes to freedom, people frequently say, well, democracy guarantees freedom. When I look at the people who are at the WEF in Davos, the World Economic Forum, and the people that are in government in the US, in Europe, and in Australia and Canada, I think these governments are horrible. First of all, most of them have no knowledge of anything at all. That's why they're qualified to be politicians, I suppose. But in addition to knowing nothing, they impose regulations and laws that are largely contrary to the constitutions we have, and certainly contrary to the idea, the Western idea that came up during the Renaissance and later on in later centuries, the age of enlightenment and so forth, the idea of individual freedom, contrary to all these principles.
What's happening in China?
Well, they imposed a strict lockdown. They used COVID as an excuse. But maybe it wasn't COVID that was the motivation for the strict lockdowns, but rather to curtail some exports to the Western world, since the Western world, driven by the media, is accusing China of every evil that occurs in the world, along with Mr. Putin. I have to mention that before Mr. Putin came up with the crane saga, it was all the Chinese that did everything wrong, and never any Western politicians. But I think the Chinese, they wake up to the fact that the world is very hostile towards them, that the Western alliance under the US and specifically NATO is pursuing foreign policy littered with hypocrisies, and therefore they are pushed in a corner and they respond and show the world that they can also curtail exports of some important items. But the Chinese economy is, of course, most likely in a recession. We have to see this very clearly.
What's caused that?
Well, we had a booming economy for the last 30 years, and this is a law of nature. You have periods of expansion in the economy, and then you have periods of recession, and only dumbed down central bankers believe that they can eliminate downturns. Like if someone comes along and says, well, I can eliminate the rain, I can eliminate the sun and so forth. Maybe these are nice ideas, but up to now it's not been realized. So I think that this is the cause of the recession, that we had a boom, and we had a credit boom, which central bankers never pay attention to. But anyway, we had excessive speculation, a boom, and now we have a period of setback.
Does it look like the U.S. stock markets have completed a significant correction and are headed higher?
Are you believing in Father Christmas? The U.S. market has had a minor correction given the huge increase in prices we had between 1982 and today. The market has gone up a lot. We had excessive speculation in 2020-21, largely because of all the stimulus packages. And as you know, the meme stocks that are, say, a reflection of the performance of meme stocks, I have to rephrase this, is the performance of the ARC Innovation Fund, which peaked out end of January 2021, more than a year ago. Since then, it's down like 70%. That is what the speculators in the market owned. These type of shares, from Zoom to Peloton to whatever, AMC and GameStop and so forth and so on. All these stocks are down 70-80%, and the rest of the market, the larger companies have held up reasonably well, but have recently also started to come down. And you say we are at a low. Well, this would be a low with record valuations. I've never seen a low with record valuations, and usually a bear market takes 2 years or so to fulfill its objective. And we started going down end of November, so the peak in the S&P was actually earlier this year, but the broad market peaked out in November. So I think we may still go down for about 1.5 years, especially given that it will be difficult for the central banks to print money at this point under the circumstances of accelerating inflation.
What do you think the real rates of inflation are in Canada and the U.S.?
Well, depends how many children you have, how many wives and girlfriends you have, and so forth. So you have to ask these questions to say, is someone who is qualified in those sectors like Hunter Biden, he would be the perfect man to ask how much is the cost of living going up. My view is that, broadly speaking, it's between, say, 7% and about 13, maybe 12, 13, 15%, depending on your position in life. And the viciousness of the inflation is, of course, that it's a tax, and it's a tax on poor people mostly. Because, as you know, the things that are going up the most are necessities of life, like health care premiums and food and energy and so forth. This is a very large percentage of the spending of poor households.
In an interview a couple of months ago, President Trump suggested interest rates could head back towards 21%. How long could interest rates remain in an uptrend, and how high could they go?
Well, this is a good question. I don't know, but I can tell you that in history, interest rate cycles last, say, around 60 years. So 30 years of rising interest rates and then 30 years of falling interest rates. This time around, we had 40 years of falling interest rates because of interventions. I have to repeat, I said interventions. A better word is manipulation by central banks that pushed interest rates to artificially low levels. And this created huge dislocations in economic activity, including asset price inflation. And now this asset price inflation is going to cool down, but it will be replaced by consumer price inflation.
Would peak interest rates likely lead to bull markets in gold and silver?
Well, we are in a period that is unfriendly for assets because liquidity is tightening. Not necessarily because of central banks, but because of the marketplace. The market has tightened liquidity. Bond yields have shot up. The long-term treasury in the U.S. is down almost 40% from the high. No, the treasury bond price is down, say, 40% from the high, like a TLT ETF. In Europe, we have government bonds that are down 50% from the highs because interest rates were pushed down to less than zero, to minus, by the ECB. And these rates, in my opinion, they will go up for a long time, whereby now the bond market, compared, say, to the stock market, is oversold. So we could get a rally in bond prices and a slight decline in interest rates, technically induced. But in the long run, I mean, for the next 20 years, I think interest rates will go up a lot. I don't think they'll go up to 21%. I think the system will be bankrupt if in the U.S. interest rates would just go to 5-6%.
Could a weaker U.S. dollar lead to bullish sentiment in the stock markets and commodities?
Well, it hasn't happened yet because the other central banks are even more woke than the U.S. central bank. I mean, in Japan, the Bank of Japan is just taking interest rates at 0.25%, and the Treasury issues the bonds, central bank buys them, but the valve in the case of Japan occurs through the currency. The yen is down 14% this year against the US dollar. This is a huge move. In fact, most currencies are down against the US dollar, except the one where the NATO and the US said, oh, we're going to beat Russia economically. As of today, year to date, the Russian ruble is up 30% against the US dollar.
Debt bubbles and real estate bubbles with interest rates on the rise. What could go wrong?
Well, as I said, I think asset prices will go down for a while. We'll have a horrific recession, depression, and I don't know what the governments will do. If they could lock us down, and hardly anyone objected to the lockdowns, and the truckers who protested peacefully were demonized, and the supporters of the BLM were idealized. I don't know what the governments will do next, but I prefer to stay outside the American alliance, which includes, of course, Canada, which has I'm an elderly gentleman. I'm 77 years old. I have to say, I've never seen such a dumb leader as Mr. Trudeau. Never, ever, anywhere. And with this ignorant and incredible arrogance, I can't believe any Canadian, and I have a high regard for Canadian society. I always thought they're free-loving people, easygoing, hardworking, that any one of a Canadian would vote for Mr. Trudeau. For me, this is incomprehensible.
Record high gasoline and diesel prices are being accompanied by a significant push for people to buy electric vehicles. Could this be a boon for commodities from copper to lithium?
Yeah, the whole ESG type of nonsense will increase the cost of living for everyone. It will increase the demand for fossil fuels, I'm sorry to say. Because to say I'm producing electric vehicles, you need the electricity from somewhere. And I can assure you, you can put up through the whole Canadian territory windmills. It won't be enough to replace fossil fuels.
We're hearing bad things about the experimental injections being pushed on people around the world. Could the devastation caused by the human trials end up affecting markets from stocks to real estate?
Yeah, sure, no doubt. I always say we had a capitalistic system and a free market in the 19th century. And I recommend this to your viewers and listeners. I reread some speeches by Milton Friedman in the years 1978, when inflation also had accelerated and so forth. And he talked about different myths. And he says, in the 19th century in America, the federal government share of the economy was 3%. They spent 3% of the total output of GDP. Now it's closer to 50% in most Western developed nations. We have introduced socialism, far too much socialism, and as a result of that, individualism and freedom of the individual has gone down.
Contrary to what the mainstream news media is telling us, we're hearing Russia could be the good guy in the Russia-Ukraine conflict. What are you hearing?
Well, I don't think that in wars there is a good guy, but it is clear that some people in the U.S. at the State Department, this Victoria Nuland, and people like Soros, they wanted to get rid of Putin. They wanted a war. And Putin, he took the bite, and rightly so, because he will gain the eastern part of Ukraine. He's not going to let that go. The NATO could send soldiers, they wouldn't win the war, because the next thing Putin would do is blow up the NATO headquarters in Brussels. You understand? This war is the most preventable war that has ever occurred, and it happened because of some loonies in the U.S. who believe that this eastern part of Ukraine has any strategic value for the U.S. It has the Crimea half island has a strategic value for Russia, and it always had. But gradually, the Western world under the NATO, that NATO is the US. Most European countries, like Germany, they don't really have an army. So the NATO is US. They enlarged NATO towards the east. They wanted then to include Ukraine into NATO. And Russian, specifically Putin, he said repeatedly, we don't accept that. We don't want missile bases next to our country, which is understandable. The US wouldn't want to have Putin set up military and naval bases and missile bases in Mexico, or we have the example in Cuba. So it's all there.
Well, you do have Russia and the Aleutian Islands of Alaska right next door to each other, so the U.S. and Russia are actually very close. Do you think the globalist Agenda 2030, the Great Reset, where you will own nothing and be happy about it, will be successful against the people?
I don't think so.
Why not?
Well, I think that, of course, if you tell everybody you must take a vaccine, like Mr. Trudeau and these clowns, and they inject something into your body where you become kind of a robot and docile, then everything is possible. But there will be people in the world, almost 90%, that will not go along with it. And when the US says the whole world is sanctioning Russia, well, I have to tell you, close to 90% of all the people living in the world are not sanctioning Russia. Canadians could vote for someone like Trudeau. They also believe the BS that Mr. Biden is telling them.
What do you think of central bankers and their push for central bank digital currencies?
Well, whether the central banks have money which they can print or digital currencies which they print will be about the same. I think we need a central bank reform in the sense that central bankers are no longer allowed and permitted to increase the money supply in an unlimited fashion. We have to go back to sound money, which is a precondition to a free society, is sound money and value as a store of wealth or a store of value. If you print money, everything gets distorted. That's why I think the crisis that is coming is going to be very serious.
Overall, are you seeing gloom, boom, or doom ahead?
Well, I think that it will be good for mankind to have a serious recession. It will be good, especially if wealthy people lose money, because it will turn them away from the socialist ideology, and it will turn them away from appointing judges that are truly woke, that don't want to punish crimes severely. It will also probably imprison some politicians. I mean, what is remarkable is when you have in an economy nowadays in Western Europe and North American continent and Australia, the government makes up roughly 50% of the economy with all the tax receipts and so forth. And of those people, hardly anyone has ever been to jail. Once in a while, they find someone who is inconvenient for the media and inconvenient for the ruling party, then they throw him out like they tried to impeach Trump. It's ridiculous. He didn't do anything wrong. He didn't conspire with Russia. The Democrats did.
Mark, how can people find out more about your report, Gloom, Boom, and Doom, and how can they subscribe?
Well, I'm not sure they want to find out more after what I just said. But as I said, they can go to gloomboomdoom.com, all in one word, gloomboomdoom.com.
Mark, thank you so much for being on This Week in Money.
Okay, my pleasure. Thank you very much for having me on your program, and I wish your listeners all the best. I think people have to change their mindset from how much can I earn to how much and in what will I lose the least.
Mark, thanks again.
Bye-bye. Thank you.
My guest has been Dr. Marc Faber, publisher of the Gloom Boom Doom Report. You can find it online at gloomboomdoom.com. He was speaking to us from Chiang Mai, Thailand. Coming up, Victor Adair, next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Victor Adair, recently retired from nearly 50 years of being in the brokerage business in BC, but still very active in the markets. His website, victoradair.ca. He's speaking to us from Vancouver Island. Welcome back to This Week in Money, Victor.
Tim, it's always a pleasure to talk with you. Thank you.
Victor, I remember you saying it's all about the central banks many years ago, and it looks like that's still the case today. Another expression was, don't fight the Fed. Well, what are the central banks doing now, and what impact are they having on the markets?
Well, right at the very moment, let's say this week, the markets are having to scratch their heads and reprice once again just exactly how aggressive are the central banks going to be. But let's back up a bit. You go back to, Paul Volcker, for instance, became the head of the Federal Reserve in 1979. Jimmy Carter appointed him, and he's the guy that took short-term interest rates up to about 20% to try to break the back of the inflation that had built up in the United States during the 1970s. And actually, he succeeded. Because for many years, for decades, really, we didn't have much in terms of what would be traditionally called inflation. We had inflation here and there and all that sort of thing. But then we kind of got into an era beginning with Greenspan, and he started at 1987, just a couple of months before the crash in October of 87. Greenspan, then Bernanke, then Yellen, and now Powell, where the Fed became more and more, it seemed, important every day. It wasn't just like from time to time the central bank would have an impact. And the trend seemed to be over a 20-year period or so where the Fed just, anytime a problem came up, they'd throw money at it. Okay, forgive me, I'm speaking in a vernacular, but just to make a point. With easier money, lower interest rates, what have you. Certainly since say the Volcker drove rates way up, and then they began to back down. So we went through a period of well more than 40 years where interest rates trended lower, and not surprisingly, during that same 40-year period, stocks trended higher. They just seemed to go hand in glove. So what it may be happening now is that there's been a change of tune at the Fed. Now, I'd say maybe the most aggressively easy the Fed ever was when the COVID hit. And I think they had written a playbook, like if we ever get in real trouble again, we're going to have to go big or go home. And I tell you, they went big. Their balance sheet exploded. Trillions of dollars went into the system. And at the same time, of course, there was the aggressive pushing of money into people's bank accounts by the government. So, they really pulled out all the stops sort of post-COVID. Now, one of the barometers of that would be, the stock market doubled from COVID lows to the recent highs here we had a couple of months ago. And a good part of that was all of that money that got put into the system. Anyhow, to come back to the here and now, the central banks maybe, and there'd be a lot of argument about this, have sort of got religion, and they realized after, especially let's go with the Fed, because everybody else kind of falls in line after that, behind them, I should say. They talked transitory for too long. They've admitted it. Gee whiz, if we'd have known, back then what we know now, we would have done things differently. Who wouldn't? But they have decided they're going to get tougher on trying to fight inflation. Now, whether or not they'll succeed, that's another argument, because a lot of the inflation may be not directly tied to interest rate policy. But the theory here, I guess, would be if all of the easy programs that they had helped cause inflation, if they reverse that, maybe inflation will go away. Or you could say it's demand destruction. If they push interest rates high enough, it'll kill the economy, as it were, and then, we won't have inflation anymore. A couple of weeks ago, maybe a month or so ago, I think the market was beginning to think, okay, we're at peak inflation, year-over-year effects and all that sort of thing. We're at peak Fed tightening, and now, okay, we got that behind us. We can look forward and with that in mind. This week here, particularly on Friday, when we had the CPI report come out in the United States, much stronger than anybody expected. Consumer sentiment report on Friday morning, much weaker than anybody expected. I think maybe the weakest ever. In other words, consumers are really worried about inflation right now. That's a big concern. That hit the market, and in a nutshell, we have interest rates higher, we've got stocks lower, we've got the U.S. dollar higher, and the commodity market here, which has been on a hell of a tear, is a little bit lower. That's kind of where we're at right now.
Let's run through the markets one at a time, starting with rising interest rates, which seem to influence everything. What do you see there?
Well, we could go to Thursday of this week. The European Central Bank had their scheduled meeting, and this was going to be their moment in the limelight. And they came up short, honestly. The inflation rate in Europe is off the charts relative to where it's been the last several decades. The ECB decided that what they do is, starting next month, not right now, but next month, they would raise interest rates by 0.25% and see if that made any difference. I'm being a bit sarcastic here, but I'm talking as a trader. And they would stop some of the bond buying they've been doing. So one of the effects of that is that the yields on the weaker credits, like say Greece and Italy, just soared relative to Germany. I think the yield on the Italian 10-year has about tripled from the beginning of the year. So, for the past many years, the European Central Bank has been the buyer in the market. And anybody that bought, say, an Italian bond kind of knew they had a backstop that the ECB would be there to take it off their hands if they didn't like it anymore. So now, if the central bank is not going to be there buying bonds, then in some way or another, the countries are going to have to find a level at what people would lend the money, and it's a higher number. We have the Fed, as I say, the market responding to what they think the Fed's going to do with the surge in CPI. We have a Fed meeting coming up next week. The markets, when we have these forward dates where, in the futures markets, where we can see what the market's expecting rates will be at different points in time in the future. So the market's looking for the Fed to push interest rates sharply higher here over the next several months. The current yield on the 10-year bond in the United States went to an 11-year high at the end of the week. When I mentioned consumer confidence, that's really important. That's people are worried more about inflation than about anything else, and that's coming into the markets as well. So inflation's the problem. What's the Fed going to do about it is a problem, and I think in some respects here, people are just saying, "Hey, take my money off the table here. I don't want to be exposed to these risks." In Canada, on Friday morning, we had the employment report come out, and I'll have to say over the years I've been suspicious, at the least, of the validity of the employment reports we get in Canada. However, they printed a number that showed that the unemployment rate in this country was at a 46-year low. Housing market's been very hot, and this is just further ammo, as it were, for the Bank of Canada to remain aggressive in terms of pushing interest rates higher here. So the theme here is that, the European Central Bank, the Fed, the Bank of Canada, the Bank of England are all in a process of trying to push interest rates higher to try to kill inflation. The risk is that they may kill other things as well, including the economy. Meanwhile, over in Japan, they are staying very, very easy. They don't have any inflation really that they want to kill, although we can get into that later. But the real focus here is on the Fed and their leading, where the Bank of England, the ECB, and Bank of Canada is sort of taking a page from the same playbook.
It's obvious the stock market doesn't like rising interest rates. After all, there's a record amount of margin debt out there. But what other things are weighing on stocks?
Let's go to this one of my favorites. The stock market, the indices, have doubled from the lows we had in March of 2020, the COVID panic lows, they call it. And of course, during that work from home period of time and all that, we had some spectacular high-flying stocks. People maybe had nothing to do, so they were speculating in the stock market, the easy way to get rich and all that sort of thing. So we had a lot of froth and speculation in the stock market. And not only are we a double from the March lows, the main indices here are up 7 times, from where they were in the lows of 2008. And we've had this thinking, and it's hard to deny, that the stock market only goes up. You want to make money, you put money in the stock market. And there's been an industry that has promoted what I call passive investing, what's known as passive investing, where you just buy the whole market. You give your money to a money manager, and they buy these instruments that reflect the whole market instead of trying to time a market or pick one particular stock. You just buy the whole market, and you keep buying it every month. So we've had enormous flows of money go into the stock market, and of course it becomes a bit of a virtuous circle. The more it goes up, the more money that comes in. Well, the more money that comes in, the more it goes up, and so on. So we've had that, and I think there's folks, including me, that have noticed this over the years. And I've been trading for 50 years, and you see these ups and downs and big cycles, and you think, this is probably kind of frothy, maybe getting ahead of itself, and maybe I'll be careful or I'll be thoughtful about where I have my money and move it around, maybe, just anticipate that a lot of this could fall. Now, I know that in some of the indices, like I believe the NASDAQ index, that something like 50% of the stocks in that index are down, more than 50% from their highs. So, there has been pervasive weakness, and this sort of a big picture that I'm talking about. More on a day-to-day thing, the consumer spending is 70% of the economy in the United States. If the consumer is getting worried, then that's a problem. We are seeing that credit card debt is really surging. So we know that the increase in wages, which is, let's say, about 4% year over year, is well behind what inflation is. So for people that are, living paycheck to paycheck, for instance, they're falling behind. And the inflation is really a problem, and that's going to be an issue certainly in the elections coming up this fall in the United States. But also, it's a same kind of a problem here in Canada, where the consumer, if he can't afford to spend, if he's spending his savings and they're gone, and he's now using his credit card to buy staples, the things you need day to day, you just think there's a really good chance that we're going to have a slowdown or a recession. And there's a whole school of analysts out there that are saying the Fed is going to tighten things here right into a recession. That we already are, in a stagflationary environment. So these are the kind of things I think the stock market worries about, that maybe if the consumers aren't buying, earnings go down, multiples go down. If interest rates are rising, then that's a whole other impact on stock prices. So, there's lots to worry about. And maybe, I think I may have used this expression with you before, during this period of time where people thought that stocks only go up, a lot of folks that probably should have just remained as savers became traders and found out the hard way that making money in the stock market is not as easy as some people pitched them, on an idea that they could do that.
You've been bullish on the U.S. dollar in just about every interview we've ever done. Have you changed your mind for any reason?
That depends on time frame, of course. I mean, and currency, one currency or another against the U.S. dollar. But essentially, in this environment, no. I know you have Bob Hoy on your show from time to time, and Bobby's been a friend of mine for a long, long time. And he talks about the senior currency, and these days it is the U.S. dollar. Years and years ago it was the British pound, and so on. But that the senior currency remains strong in an environment, say, where you have a lot of correcting of excesses. Anyway, I generally think the U.S. dollar stays strong. It certainly has been strong against the Japanese yen here. That's at a 20-year low. I've used the expression so many times on your show that capital will come to America for safety and for opportunity. When the world is a worrisome place, you want to have your money in the United States, instead of Venezuela or Turkey or, any Sweden or whatever. Capital will go to America. There are folks out there that make a living by telling people that, the dollar isn't worth the paper it's printed on. I understand the argument, but when we're talking currency markets, we're talking about one currency relative to another, and the old saw is that the U.S. dollar is the cleanest dirty shirt in the hamper. We're in Canada, so let's go to the Canadian dollar. We usually think of the Canadian dollar in terms of what it's worth in U.S. dollar terms. And, we had Canada, maybe just very recently here when the stock market was really having a hissy fit back in the beginning of May. Canadian dollar traded down to a 20-month low when the S&P was making a 14-month low. And at that same time, that's when the U.S. dollar index was hitting 105, which was a 20-year low around the beginning of May. So since then, the Canada rallied back to 80 cents, but the past couple of days here, it's fallen back as the U.S. dollar has been strengthening and as the people have been worried about the stock market. Again, with Canada, we've talked on the show before, I think that the main three influences over a big chunk of time, let's say a 20-year window, is the relative strength or weakness of the U.S. dollar, whether the market is in a risk-on or risk-off mood. If the market's feeling that it wants to take a chance, embrace risk, Canada's more likely to be bid. And then the commodity market. Now, lately, there's another factors come into play, and that is the relative interest rate spreads. Canada short-term rates have actually been at a premium to the U.S., so that's given Canada a play there, or an edge there that it might not otherwise have had. Now, Canada has not been as strong as it might have been given how strong the commodity market has been. And you say, gee, well, why is that? Because historically, the two look like they're joined at the hip. I would say the answer to that puzzle is that the strength of the U.S. dollar it's been so strong that it has overwhelmed this Canada tied to commodity market factor. And I'll make my point there by saying that the Canadian dollar is at a 9-year high relative to the British pound, to the Scandinavian currencies, to the euro, and at a 14-year high relative to the yen. So the commodity aspect of the Canadian dollar is still real when you look at it versus those other currencies. It's just that when you look at Canada versus the U.S. dollar has been so strong it's kind of sort of trumped, if we can use that word, the impact that commodities would have on Canada. So anyway, those are kind of my thoughts here on the currency markets. I think the U.S. dollar, on balance, stays stronger. And again, it's always a matter of your time frame. And for instance, the U.S. dollar trades mostly or the currency that's traded mostly against the U.S. dollar is the euro currency, and then after that the yen, and then after that, a whole number of things. And the ECB had a chance this week to give the euro a boost, but they were so weak, I guess, in terms of what their central bank plans to do relative to inflation compared to the Fed, that the euro currency just sort of fell like a stone the last 2 days of this week. So the euro is a big part of what makes up the dollar basket. The U.S. dollar is strong, and I think on balance that's going to continue.
The leading commodity indices hit 20-year lows when COVID hit in March of 2020. Since then, commodities have had a terrific rally, with most of the gains coming from the energy markets. Do you see this bull trend continuing?
Let's say probably. There's a very strong narrative around the energy market, and I've written in my blog so many times, how the consequences of poor energy policies are coming back to haunt us right now, and there's probably nobody that's shaken their heads more than the Europeans, who sort of put themselves at the mercy of importing a lot of their energy from Russia, and now they're probably wishing they couldn't have, but it's not something you could fix right away. The narrative is so strong. In other words, I see in different sectors of the stock market that the energy sector is just a runaway leader. Everything else looks like not even in the race compared to how well the energy sector is outperforming all the other sectors in the stock market. And hence, no surprise, a lot of people are buying oil stocks, buying refinery stocks, whatever. It just looks like it's a layup. So I always get a little suspicious about that. So on a timing basis, probably be aware that everybody and his dog thinks that energy is going to continue to go higher. And, it well might, given that we need it every day, and there seems to be certainly not only a short supply, but or you could say limited spare capacity. Like if we really had another problem hit the market right now, where like Russia oil is not coming to the market, Russian natural gas is not coming to the market like it was before. If something like that happened, we just have no backup supply. Speaking of energy in particular, certainly gasoline prices are probably mostly front and center in the news. Diesel prices, a lot of people didn't even know about diesel, see that, it's also high. And certainly we talk about crude oil. Sort of the sleeper here has been natural gas. It's just been a spectacular rally in natural gas in Europe because of the thoughts that there wasn't going to be any or not enough coming from Russia. But gas prices in North America, the NYMEX natural gas contract is a triple from where it was in December. And a big part of that is that there's natural gas now being turned into LNG and taken across the Atlantic to Europe to try to alleviate the lack of supply they're getting from Russia, and that is tightening up the supply of nat gas in North America. So nat gas, kind of the unsung hero here in terms of how much it's gone up, and just it's not in the news as much as the other markets. The commodity market has been dominated by energy. I think I got to say a word here on gold. At the end of this week, we saw the gold market surge up, say, $50, I think, between the low on Friday and the high on Friday, and that came at a time when the U.S. dollar was really surging higher as well. It's a rare thing to see gold and the U.S. dollar both up at the same time, and it's almost always happening when the market is really worried about something. So we got some real stress in the market here at the end of the week, with people trying to reprice just how aggressive the central banks are going to be, how strong inflation is going to be, and that's put a bid in both the dollar and gold at the same time.
Now, Victor, you've been writing a blog for more than 20 years. For the past couple of years, you've posted the weekly trading desk notes on your website at victoradair.ca. You post terrific charts with brief comments on each market written from a trader's point of view. You comment on trades you've made, trades you might have made. You've recently added a section on how you manage trading risks. Now, everybody has free access to the blog. It's not a paid subscription service. So why do you write this trading desk note every week?
Well, sometimes I ask myself that, Jimmy. I tell you, it's as you probably well know, it's a lot of work. But, I started writing a blog, certainly almost back in the days when the Internet was just getting going, but certainly more than 20 years ago. And part of that was I did a weekly interview with my friend Michael Campbell on his very popular radio show, and I'd make some notes to send to Mike to kind of organize my thoughts, I guess, and also to give him some ideas about what I'd be prepared to talk about. I mean, let's not be stumbling around on live radio. So that was kind of the genesis of it, and then over time, I just decided, well, I'd sort of take the notes and fancy them up, put some charts on them, and put it on my website, and things just kind of went from there. That when I was a broker, and I was in the brokerage business until 2 years ago, it was also a way for people to see, okay, here's how this guy thinks. Maybe I like what he thinks, and they'd call me up, or my son and I worked together. It was call it a marketing tool. People could come to us and become clients. I retired from the business 2 years ago. I continued to do the notes. I guess I was just in the habit of doing it. It actually is good discipline for me to think about what do I really think on different markets, and to kind of dig to say, look at this. If you see this, then you have to say, well, if that's the case, then how about this other idea? That kind of thinking. I still do a weekly radio and podcast with my friend Michael, so that's another reason to do the notes. Maybe one of the things I don't want to do, and that is I don't want to write down or recommend, say, specific buy and sell ideas. And the reason for that is because I changed my mind, I think a big part of my risk management is that I recognize that a lot of the brain waves I have when I actually, hit the buy button or the sell button on my machine, that the trade often turns out that it doesn't work, or I may just say, yeah, the market is doing this or that, and my rationale doesn't make any sense anymore, so I just want out of it. So if I'm trying to post on a weekly, make a trade recommendation, and I'm going to change my mind 3 days later or something like that, that's just the wrong thing to do. What I'm trying to do is maybe give folks a window into my thinking, into why I do some of the things I do, how I make money. And I keep using the line that I make money trading not because I've got a great crystal ball, but because I really am very disciplined about managing my risks. And I just hope that people can get a good idea about what, or take something away from my thinking, my website, that they can use for themselves. Now, at one time, I certainly did think that I might make it a paid subscription service, but I don't think I'm going to go that way. Honestly, it would just be way more work than I'm willing to put in. And my main goal, the thing that I spend most of my business time on, is trading, and taking time away from that kind of shoots myself in the foot. Oh, one other thing. One of the really neat things about writing the blog is, and there's a few thousand people around the world read it, is that I get feedback or comments, or I get hooked up in one way or another with folks that I would never have been in touch with. People will say, hey, I read your blog, but here's an idea I've got, or, what do you think about this? And we can go back and forth, share some notes, and that's been great fun. So I think I'll keep doing it, and if it stops being fun, then I'll stop.
Victor, thank you so much for being on This Week in Money.
Jim, it is always a pleasure to talk with you. Thanks for having me on the show.
My guest has been Victor Adair. Check out his website, victoradair.ca. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Marc Faber, and Victor Adair. And thank you for listening. If you have any questions for the show or any of our guests, you can send them to info@howstreet.com, and we'll ask that question for you. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.